Most of us never think about the Japanese yen. Maybe you've got a few notes left from a Tokyo trip propping up a wobbly table. But in August 2024, the yen suddenly surged, sending shockwaves through global markets. Stocks tumbled, traders panicked, and billions evaporated overnight. The culprit? The yen carry trade. A decades-old financial trick that quietly props up markets worldwide, until it doesn't. This isn't just Wall Street drama. It's about how a policy in Japan can shake your retirement account in Ohio, so buckle up. We're diving into the weird, powerful world of the yen carry trade, and why it matters to you. To get the yen carry trade, you need to know why Japanese money became so cheap. In the 1980s, Japan's economy was booming, until the bubble burst in 1990, plunging the country into decades of stagnation. The Bank of Japan slashed interest rates to zero, even dipping negative by 2016, trying to revive growth. Borrowing money in Japan became almost free. Imagine getting a loan at 0.5% interest. With no returns at home, Japanese investors started pouring trillions of yen into foreign markets, hunting for yield. Japan became the world's biggest creditor, exporting cheap money everywhere. This wasn't a grand plan, it was desperation. And it set the stage for the global phenomenon of the yen carry trade. The yen carry trade is simple. Borrow cheap yen, convert it to a higher-yielding currency, invest, and pocket the difference. It's like buying soda for 25 cents and selling it for $5, on a global scale. As long as the yen stays weak, profits roll in. If it weakens more, you win extra. But if the yen suddenly strengthens, your profits vanish. And losses can be catastrophic. It's a classic picking up pennies in front of a steamroller strategy. Hedge funds and banks love it. Until the music stops. The risk? You have to pay back your loan in yen, and if the exchange rate turns, you're in trouble. It's great, until it's not. The yen carry trade, a strategy of borrowing in Japanese yen, and investing in higher-yielding currencies or assets, has made and broken fortunes across the globe. It's a high-stakes game where the potential for profit is matched only by the risk of catastrophic loss. Fortunes can be built rapidly, but they can also vanish just as quickly, leaving investors reeling from the sudden shift in market dynamics. In the 2000s, Australia, with its robust economy and relatively high interest rates, was a favorite destination for yen carry traders. Investors borrowed yen, taking advantage of Japan's ultra-low interest rate environment. This made borrowing incredibly cheap, fueling the carry trade strategy. They then bought Aussie dollars, seeking to capitalize on the higher interest rates offered by Australian bonds and other investments. This influx of capital drove up the value of the Australian dollar and allowed investors to rake in profits from both the interest rate differential and the currency appreciation. It seemed like a foolproof strategy. The Australian dollar strengthened considerably, and interest rates remained attractive, creating a virtuous cycle for carry traders. The returns were substantial, attracting even more investors to the trade. Then the unforeseen happened. The 2008 global financial crisis hit, sending shockwaves through the world economy. The Aussie dollar, once a symbol of prosperity, crashed as global markets panicked and investors fled risky assets. As investors scrambled to repay their yen-denominated loans, the yen soared in value, exacerbating the losses for those caught on the wrong side of the trade. Years of accumulated gains were completely evaporated in a matter of months, leaving many investors financially ruined and serving as a stark reminder of the dangers of currency speculation. In Turkey, a similar story unfolded as Japanese retail investors, affectionately nicknamed Mrs. Watanabe, they chased the allure of high yields in Turkish lira-denominated bonds, drawn in by the promise of substantial returns. However, their dreams turned into a nightmare when the Turkish lira experienced a dramatic collapse in 2018, triggered by a combination of economic and political factors. The sudden devaluation of the lira wiped out their savings almost overnight, leaving them with devastating losses and a profound sense of betrayal. The pattern, as history has repeatedly shown, is always the same, a predictable cycle of boom and bust. There's easy money to be made on the way up, during periods of economic expansion and market optimism, but there are brutal losses awaiting on the way down, when the market inevitably corrects and the tide turns against those who were over-leveraged or overly complacent. The carry trade, while seemingly innocuous, quietly inflates financial bubbles by encouraging excessive risk-taking and distorting asset prices. But the inevitable reversal is always sudden, swift, and unforgiving, catching many investors off guard and leading to widespread panic selling. These stories serve as stark warnings, cautionary tales about the perils of chasing high yields without fully understanding the underlying risks. While the carry trade's potential rewards are undeniably real and can be quite substantial for those who time it right, the associated risks are equally real and should not be underestimated. When the tide turns against you in the carry trade, it turns with incredible speed and force, leaving little room for escape. And nobody, regardless of their experience or sophistication, is truly immune to the devastating consequences of a carry trade gone wrong. The Bank of Japan for decades has pursued a policy of near zero and sometimes even negative interest rates. This has created a unique situation, a vast pool of cheap money sloshing around the Japanese financial system. But cheap Japanese money doesn't stay in Japan. It's an economic imperative that it seeks higher returns elsewhere. It floods global markets, quietly inflating bubbles everywhere. This phenomenon, known as the yen carry trade, involves borrowing yen at these ultra-low rates and then investing that money in higher-yielding assets in other countries. It's a seemingly simple strategy, but its impact on the global economy has been profound and often destabilizing. The allure of easy profits has drawn in hedge funds, institutional investors, and even individual traders, all eager to capitalize on the interest rate differential. In the mid-2000s, the yen carry trade fueled everything from U.S. housing. The influx of cheap yen helped to keep mortgage rates low, contributing to the housing boom that ultimately led to the subprime mortgage crisis. It was a classic example of how seemingly isolated monetary policies in one country can have far-reaching consequences across the globe. To Icelandic banks, the small island nation became a magnet for yen carry trade investments, as its banks offered relatively high interest rates. This fueled rapid growth in the Icelandic financial sector, but also created a massive bubble that eventually burst, triggering a severe economic crisis. When the 2008 crisis hit, the carry trade unwound fast. As global markets plummeted and risk aversion soared, investors scrambled to repay their yen loans, triggering a massive surge in demand for the Japanese currency. Investors rushed to buy yen, markets crashed harder. The sudden repatriation of yen exacerbated the market turmoil, contributing to the severity of the global financial crisis. It was a painful lesson in the interconnectedness of the global financial system and the dangers of relying on cheap money. After 2013, Japan doubled down on easy money. Under the banner of Abenomics, the Japanese government launched an even more aggressive program of monetary easing, pushing interest rates further into negative territory and flooding the market with liquidity. And the carry trade came roaring back bigger and bolder than before. With even lower borrowing costs, the incentive to invest yen abroad became even stronger, fueling new asset bubbles in various corners of the globe, juicing U.S. tech stocks and more. The tech sector, with its high growth potential and relatively high valuations, became a prime target for yen carry trade investments. The influx of cheap money helped to drive up stock prices, creating a sense of euphoria that masked underlying risks. By 2022, the gap between U.S. and Japanese rates was huge, as the Federal Reserve began raising interest rates to combat inflation, while the Bank of Japan stubbornly stuck to its ultra-loose monetary policy, fueling a massive new wave of carry trades. This widening interest rate differential created an irresistible opportunity for arbitrage, attracting even more capital into the yen carry trade and further exacerbating global imbalances. But as 2024 showed, even a tiny policy change in Japan, a subtle shift in rhetoric or a minor adjustment to its yield curve control policy, can have an outsized impact on global markets, can send global markets reeling. The mere hint that the Bank of Japan might be considering tightening its monetary policy can trigger a rush to unwind yen carry trades, leading to sharp declines in asset prices and increased market volatility. The world's financial system is more dependent on cheap yen and the carry trade it fuels than most people realize. It's a hidden vulnerability that lurks beneath the surface of global markets, waiting to be exposed. Than most people realize. The intricate web of financial connections that spans the globe means that even seemingly small events in one country can have ripple effects across the entire system. And when that flow reverses, the fallout is global. The unwinding of the yen carry trade has the potential to trigger a cascade of selling, leading to a global financial crisis. It's a risk that policymakers and investors alike need to be aware of and prepared for. The real danger, the lurking threat that keeps financial regulators up at night, comes when the carry trade unwinds. It's not just a minor correction or a temporary dip, It's a fundamental shift in the market's dynamics, a seismic event waiting to happen. This unwinding isn't a gradual process, it's often a rapid and chaotic scramble for the exit, a stampede where everyone tries to get out at once. A small policy tweak, seemingly insignificant on its own, a barely perceptible adjustment to interest rates, a global shock, an unexpected geopolitical event, a sudden economic downturn in a major market. Suddenly everyone wants yen, not risk. The appetite for high-yield, high-risk assets vanishes overnight, replaced by a desperate flight to safety. The yen, traditionally seen as a safe haven currency, becomes the most sought-after asset in the world. Investors dump foreign assets, sell off their holdings in emerging markets, and liquidate their positions in anything perceived as risky. They buy yen to repay loans, desperately trying to cover their short yen positions before the currency appreciates further. And the yen surges. Its value skyrockets against other currencies, creating a ripple effect throughout the global financial system. For carry traders, it's a nightmare, a perfect storm of adverse conditions converging at once. Their assets fall, the value of their investments plummets, and their debts explode. The cost of repaying their yen loans spirals out of control, wiping out their profits and pushing them into the red. In 2008, during the height of the global financial crisis, the yen jumped 30% in a year, a dramatic and unprecedented move that sent shockwaves through the markets, turning profits into massive losses. What once seemed like a sure bet became a financial disaster, leaving many investors reeling. Forced selling adds fuel to market crashes as desperate investors are forced to liquidate their assets at fire sale prices to cover their losses, creating a vicious cycle. The more assets are sold, the lower prices go, triggering even more selling and exacerbating the crisis. In August 2024, a tiny rate hike by the Bank of Japan, a mere fraction of a percentage point, triggered a global sell-off. It was a stark reminder of the fragility of the system and the interconnectedness of global markets. The lesson? This giant leveraged bet, this massive accumulation of risk, is built on sand. It's a house of cards waiting to collapse at the slightest tremor. When cheap yen dries up, when the easy money disappears, the pain is swift and severe. The consequences are far-reaching, impacting not just individual investors, but the entire global economy. And the world finds out who's been swimming naked. The tide goes out, revealing the vulnerabilities and excesses that were hidden during the boom times. The yen carry trade is financial dark matter, huge, invisible, and powerful. No one knows its true size, but it shapes global markets, inflates assets, and keeps volatility low until it doesn't. Japanese money props up everything from US bonds to Australian housing. Countries get hooked on cheap capital building bubbles that can burst when the flow reverses. When Japan signals an end to easy money, the risk of a global shock rises. The dependency is dangerous. When Japanese money heads home, the fallout can be catastrophic. Economists everywhere are asking what happens when the liquidity tide turns. The answer could reshape the global economy. Not everyone thinks the yen carry trade is a ticking time bomb. Some say it's just one factor among many. US bubbles have their own causes. Regulators are more prepared now with bigger reserves and better coordination. If Japan tightens slowly, the unwind could be gradual, not explosive. But the risks are real. A sudden policy shift or global crisis could trigger chaos. The carry trade is a giant spring, coiled tighter for decades. We don't know what will set it off, or how much damage it could do, but the potential for shockwaves is always there. So why should you care? Because the yen carry trade shapes your world. It keeps borrowing costs low, boosts your investments, and fuels economic optimism. But it also makes the system fragile. One policy move in Tokyo can crash markets everywhere. When the carry trade unwinds, it can hit your savings, your job, and your ability to get a loan. It's a reminder. Our global financial plumbing is more connected and vulnerable than we think. As Japan turns off the cheap money tap, we'll see just how dependent we've become. And that's something everyone should care about.